Your portfolio is up. You feel good about it. But if you have not rebalanced in the last 12 months, what actually happened is that the market quietly moved you into a risk profile you never agreed to. And when the next correction hits, you will lose more than you should have. That is not a market problem. That is a maintenance problem. And it is one most investors never fix because no one explains it clearly. On top of that, there is a legal strategy that can quietly add 0.5% to a full percent to your after-tax returns every single year, and the majority of investors leave it completely untouched. This video fixes both. Let us start with why rebalancing matters more than most people think. When you set up a portfolio, you establish a target allocation, maybe 60% stocks and 40% bonds, or 80% equities and 20% alternatives. That allocation reflects your risk tolerance and time horizon at a specific moment. The problem is that markets move. After a strong equity bull run, what started as a 60-40 portfolio might drift to 75% equities and 25% bonds. You did not decide to take on more risk. The market did it for you. Rebalancing is the act of returning your portfolio to its intended risk profile. The reason this matters goes beyond staying organized. Research consistently shows that disciplined rebalancing enforces a buy low, sell high behavior mechanically. When equities outperform, you trim them. When bonds underperform, you add to them. When international stocks lag domestic, you add international exposure. You are systematically selling high and buying low without requiring any prediction about what will happen next. That is a remarkably powerful feature. Now the question is how often to rebalance, and this is where most investors make mistakes in one of two directions. Some rebalance too infrequently and let their portfolio drift dramatically. Others rebalance too frequently, incurring transaction costs and unnecessary tax events. The sweet spot depends on your account type and your drift tolerance. The two most common approaches are calendar rebalancing and threshold rebalancing. Calendar rebalancing means you review and adjust on a fixed schedule, quarterly or annually. Threshold rebalancing means you only act when an asset class drifts more than a set percentage from its target. Typically 5% is the standard. Research suggests threshold rebalancing tends to outperform calendar rebalancing because it responds to actual drift rather than arbitrary dates. In practice, many sophisticated investors use a hybrid. They review quarterly and only act if something has drifted beyond their threshold. In 2026, with continued volatility across equity, bond, and alternative markets, drift can happen quickly. A concentrated technology position can push your portfolio significantly overweight in that sector after a strong quarter. Without threshold monitoring, you might not notice until you have taken on dramatically more concentration risk than you intended. Here is the tax dimension that changes the entire calculus for taxable accounts. Every time you sell an appreciated asset in a taxable brokerage account, you potentially trigger a capital gains tax event. This means naive rebalancing. Selling what is overweight and buying what is underweight can create a meaningful tax bill even though you have not changed your wealth position, only your allocation. The solution is to rebalance intelligently using strategies that minimize or eliminate this tax drag. The first approach is rebalancing within tax-advantaged accounts first. If you have both a taxable brokerage and a tax-advantaged account, like a 401k or IRA, direct rebalancing trades to the tax-advantaged accounts whenever possible. Selling an overweight equity position inside your 401k and buying bonds there triggers zero tax consequences. Use this space deliberately. The second approach is using new contributions to rebalance. Instead of selling overweight assets, direct new deposits to underweight asset classes. If bonds are underweight, make your next contribution entirely to bonds until the allocation normalizes. This is the most tax-efficient rebalancing method because it involves no selling at all. The limitation is that it only works when contributions are large relative to portfolio size. Now let us go deep on tax loss harvesting, because this is where the real advanced strategy lives. Tax loss harvesting is the practice of selling investments that have declined in value to realize a loss on paper, then immediately reinvesting in a similar but not identical investment to maintain your market exposure. The realized loss offsets gains elsewhere in your portfolio, reducing your tax liability. Here is a concrete example. Suppose you hold a total U.S. market index fund and it has declined $10,000 from your purchase price. You sell it, realizing a $10,000 loss. You immediately reinvest in a slightly different fund, say a large cap blend fund, to stay invested in equities. Now you have a $10,000 realized loss that can offset $10,000 of capital gains elsewhere, or up to $3,000 of ordinary income per year if you have no gains to offset. The critical rule governing this strategy is the wash sale rule. The IRS prohibits you from claiming a loss if you buy a substantially identical security within 30 days before or after the sale. This is why you must reinvest in something similar but not identical. Selling a Vanguard total market fund and buying a Schwab total market fund may be too similar and could trigger wash sale disallowance. Selling a total market fund and buying an S&P 500 or large cap value fund is generally considered dissimilar enough. This is a nuanced area, and for large portfolios, it is worth confirming substitution choices with a tax advisor. The opportunity for tax loss harvesting is not limited to dramatic market crashes. In 2026, individual sectors regularly dip in and out of loss territory, even in otherwise positive market environments. Sophisticated investors monitor portfolios continuously or use platforms that do it automatically to capture these opportunities throughout the year rather than scrambling at year-end. Automated tax loss harvesting is now available through robo-advisors like Betterment and Wealthfront. These platforms monitor holdings daily, execute harvesting trades when the tax benefit exceeds the transaction cost, and handle wash sale compliance automatically. Studies suggest automated tax loss harvesting can add 0.5% to 1% per year in after-tax returns, which compounds significantly over decades. Here is how rebalancing and tax loss harvesting work together as a system. When you harvest a loss, you are selling one position and buying a substitute. That transaction is also an opportunity to rebalance. If equities are overweight and you have a specific equity position at a loss, harvesting that loss while sizing down the substitute purchase reduces your equity overweight simultaneously. You accomplish both goals, tax efficiency and allocation discipline, in a single set of trades. Asset location ties this entire framework together. Asset location means deliberately placing different types of investments in different account types based on their tax efficiency. Tax-inefficient assets, bonds, REITs, actively managed funds with high turnover, belong in tax-advantaged accounts like IRAs and 401ks. Tax-efficient assets, broad index funds, ETFs with low turnover, belong in taxable accounts. When asset location is optimized, the drag from taxes decreases significantly across the entire portfolio. Here is what a sophisticated 2026 investor does. They set a target allocation and monitor for 5% threshold drift. They rebalance inside tax-advantaged accounts first, using new contributions to rebalance taxable accounts wherever possible. They harvest losses in taxable accounts opportunistically throughout the year. They maintain an approved list of substitute securities that are similar but not identical to each holding, and they review asset location annually. This is not complicated to understand, but it requires consistency. The investors who implement this system do not necessarily earn higher pre-tax returns. They simply keep more of what they earn by systematically reducing tax drag over decades. On a meaningful portfolio, that difference compounds to hundreds of thousands of dollars over a lifetime. Subscribe to Daily Money Mindset for 3 videos a week covering exactly the kind of advanced, actionable strategies that change your financial outcome. Hit the like button and drop a comment below. Are you currently rebalancing your portfolio? And if so, how often? Rebalancing calculators and tax loss harvesting guides are linked in the description.